I'm here with Tom Kaplan all the way on the right and Boaz Weinstein, who are two of the world's great investors. So Tom is an entrepreneur, a philanthropist, and an environmentalist. He has 3 degrees from Oxford, bachelor's, master's, and doctoral degree in history. Focused his dissertation on counterinsurgency in Malaya and its consequences, which he is somehow, maybe he'll explain to us how this relates to gold, but he's explained that the heart of all of his investing is this dissertation. He began his career as a hedge fund analyst, got very bullish on silver, and decided that the best way to express that was by founding a company, which turned into Apex Silver, which then discovered and financed the San Cristobal deposit in Bolivia, which is now one of the largest producers of silver and zinc in the world. So then Tom got out of that, and in 1919, he decided platinum was going to go up, so he became the largest shareholder in Zimplats and in African Platinum, and then sold those to Impala Platinum for a lot more. And then in 2003, he moved on to oil and natural gas and predicted, when people would have thought this was crazy, that oil would exceed $100 a barrel, which led to the founding of Lior Energy, which developed the Amarusu field in East Texas, one of the biggest onshore natural gas discoveries in the United States. And at the time of its sale in 2007 to Encana, Lior Energy was the fastest growing privately held oil and gas exploration company in the United States. So if you're detecting a pattern here, there is one. Tom is now the chairman of the Electrum Group of companies, which is a New York City-based investment and asset management firm with a principal focus on precious metals. Tom's known as probably the world's leading evangelist for gold, and he's the chairman of Nova Gold, which is developing what will be the largest gold mine in the world. He's also, like many of the people here today, has a lot of interests. He's the co-founder and executive chairman of Panthera, which is devoted to preserving big cats and ecosystems around the globe. He was the chairman of the 92nd Street Y. He's a recipient of the Legion of Honor, a member of the Council on Foreign Relations. He's the largest collector of Rembrandt. He's a Stoic philosopher. He's an advocate for anti-extremism. And he is recently the chairman of a new French and United Arab Emirates fund to save the world's cultural heritage. So that's Tom. Boaz.
By the way, I wish Richard had read my bio first, because it's not.
Oh, we'll get into Boaz right now. So yeah. So Boaz is the founder and chief investment officer of Saba Capital Management. He's one of the leading credit traders and hedge fund managers in the world. He founded Saba in 2009 as a carve-out of something he started at Deutsche Bank called Saba Principal Strategies. And he was also at Deutsche the co-head of global credit trading, where he was responsible for overseeing 650 professionals and was a member of the Global Markets Executive Committee and oversaw a lot of money. And throughout his career at Deutsche, Boaz actually had the dual responsibility for proprietary trading and market making. So he has pretty unique insights into the way markets work, as well as an investor. And as a market maker, he was focused on credit default swaps, investment-grade bonds, and high-yield bonds, and other exotic forms of credit. So Boaz worked at Deutsche before he started Saba for 11 years and was a managing director from the age of 27. And he was a graduate of the University of Michigan, Ann Arbor. Grew up in New York City. He's an alumni of Stuyvesant, and is where he's currently on the board of directors, and he's a leadership council member of Robinhood. He's also a master chess player, which was...
I'm the second best chess player here today.
So there's a chessboard outside, so Boaz will take on people after this. And he's also a veteran of the World Series of Poker. Is that right?
Wow, you really dug deep. That's true.
Okay. Yeah. And most famously, and he likes this about as much as Nouriel likes being called Dr. Doom, but Boaz was the man who, and is the technical term, harpooned the London whale a few years ago. Okay. So there was a very bad trade for J.P. Morgan, in sort of the $6 billion range that Boaz was on the other side of. So he's known as the man who harpooned the London whale. So we're really excited that both of them are here. And let's start with you, Boaz. So there's the last panel, they talked about things that happen every 100 years or every 5,000 years. a lot of people have commented, and that, I don't know whether it's now a 100-year event, but that volatility is at an all-time low in the market. What do you make of that, and what's driving that, and how do you see that ending?
I mean, it's a topic that is so interesting, and one cannot predict exactly when it's going to change. But what's so unusual, if I just take a moment to go back, and we'll see where we want to go with it. This year, the S&P has had the lowest volatility, the lowest realized movements, for the past 10 months since 1964. And when you think about low volatility, you think about calm markets. The market's not moving very much. It's trending higher. People are not worried about things. If you think about causes, we can come up with reasons. Strong earnings would be one. But it's very hard to rationalize why exactly is the market so calm as compared to the last 53 years. And so you can talk the markets, no matter what craziness we see geopolitically, the market's still optimistic for a tax deal. You can come up with your own reasons, but sometimes when people talk about volatility and it's an attractive investment, the other side is thinking, well, but who's to say the market's going to go down? And I want to at least to distinguish it right in the beginning that you don't need low volatility. Doesn't mean it's a time to buy insurance necessarily. It also could mean it's a time to replace your holdings, let's say in the S&P, with a call on the S&P, because the option of owning that call, the volatility actually not only is realized at a 53-year low, but I've never seen, and no one has ever seen implied volatility at these lows. So the VIX you probably have seen ad nauseum since 1990, recently was the lowest reading of all time this month. So how can the markets be so calm yet? Not only what we see on television gives us pause, but also the uncertainty. Where will tax rates be? What exactly will the healthcare system look like? What exactly will be the end of the North Korea story? Or just where we sit in terms of valuation, that the market shouldn't be pricing such a low degree of uncertainty. And so it only can be explained through technicals. Most markets, most opportunities, there's a technical situation. In the London Whale example, there was a mispricing because of one side, in that case JP Morgan, taking an outsized position so gargantuan as to dwarf fundamentals. In the case of volatility, selling volatility has been so productive for investors. Investors who look at it really as a surrogate for income, for yield that they can't get in the credit markets because of rates being so low. And so, one buyer base, one investor selling volatility has really grown over the last few years, and now is fairly enormous, which also, at the same time, as every dip seems to have been a buying opportunity, if vol shoots up because of a Comey announcement or what have you, they add to it. And so there's this idea that the people who are selling volatility will continue to do so for medium-term events. But if there was an event large enough to cause the dip not to have been a buying opportunity, you now have so many people off sides who are not career volatility sellers who were in it because it had been working, who now have to cover their risk, in addition to everyone else who's underprotected. And so there is so much discussion right now at the Goldman Sachs and Morgan Stanleys of the world around what would a 3 or 4% drop mean to the market? Would it, in fact, cause a 10% drop because of all this covering? But I wanted to at least say at the outset that it doesn't need to be one should not own volatility if you're not expecting a giant drop. The cost of owning upside, owning calls in the market, has never, in anyone's career, it's not that I don't have enough gray hairs, it's never been cheaper. You can actually buy, in the very short end, implied volatility, what's being priced for the next few weeks, even lower than this 53-year low that we're experiencing this year. So both implied, realized, it's not too many markets where you have lots of different trades that are basically the best they've ever been in 10, 20, 30 years.
But Boaz, who is on the other side of that trade? It feels a little bit like the guys that were, buying protection on subprime at 50 basis points, and then it didn't feel like such a good idea. But who is this massive short on volatility?
So I actually, it extends even significantly to retail investors. I see it in Asia, structured notes that are being created that are made to quack and walk like a bond. It has a maturity, it has a coupon, but its ultimate repayment is tied to there not being a decline in the stock market. And so the retail investor, is buying a note that really is they sold a put on the equity market, and that's not something too many people in this room have done. But there are investors that believe shorting volatility, and because, not to get too technical, there's an upward sloping curve. The level of volatility out in 3 months is considerably higher than 1 month, that they want to roll down the curve, the same as the yield curve, and earn yield. So there's momentum sellers of volatility. There's risk parity funds that you may have read about that are selling volatility. There are people just outright short volatility, and those volumes are tracked. And they're off the scale. They're off the scale. The largest ever supply of volatility comes at the time that it's never been lower, and so that bargain for them, maybe not today and maybe not next month, I think will prove to have been a terrible investment, because the hurdle for what needs to happen for them to lose money is really not that high. If you just take, let's say one other thing. Last year, volatility was average over the last 50 years. The realized volatility of the S&P, you don't have to get into what it all means, but it was 12.5. In years prior, maybe it was 11 or 10. This year, it's 7. And so if you're buying volatility at 6 or 7, it doesn't need to be 20 for you to have been happy you bought it. It just needs to be 9 or 10, which would even be low by historical standards. And so as vol goes lower and lower, basically the cost of you buying insurance to protect your downside becomes so small, and I believe the regret will be so great if something happens later in the markets and you say, well, actually, was there anything you could have done? Actually, you could have never protected your downside for less than it costs today, yet so many people are not only not doing it, they're actually on the other side of the trade, and this is incredible.
So Tom, you once said to me that being bullish on gold is the only kind of investment where you get compared to an insect as a gold bug. Mm-hmm. So the latest critique of gold, which comes from the millennial generation, is why would anybody buy gold? Why not buy Bitcoin or Ethereum or a cryptocurrency? So I'm going to ask you, why should someone buy gold? And if they want to buy gold, why not just buy Bitcoin?
Let me dispense with the last part first. I don't think that Bitcoin and gold have anything really to do with each other. The case for Bitcoin, depending on who you listen to, could be that, as Larry Fink put it, it's a great gauge of money laundering. Obviously, Jamie Dimon referred to it as stupid, and then I know other people, venture capitalists, who believe that that is absolutely the future. I don't believe that Bitcoin itself represents a challenge to gold. Ultimately, Bitcoin is the ultimate fiat currency, and gold is the opposite of a fiat currency. It's the only currency which does not represent in any way someone else's liability. Now, you heard from Jim Grant, you heard from Nouriel, you've heard from Boaz. A common underlying theme is that we are in uncharted waters. And my philosophy is that I start with a macro theme and then try to locate the best bottom-up way to be able to give me leverage to that theme. For me, and it suits my temperament, and first and foremost as an investor, I think that one should unto thine own self be true. Gold represents the best risk-reward ratio of any asset class. And there are a few reasons for this. And I'm going to put aside what I call the fear factors. Like patriotism, the fear factors for gold are the last refuge of the scoundrel. If I can't persuade someone that gold is worth owning or silver is worth owning because of the positive reasons, economics 101, the supply-demand of the underlying asset itself, then you're relying on a much more atavistic, visceral fear, and that's not necessary in the case of gold. Having said that, should the scenarios which our previous speakers, including Boaz, have referred to with regard to central banks and volatility prove to be true, then I would argue that just as gold was the best asset to own during the last financial crisis, that it will protect you from any of the multiple black swans that Nouriel was referring to, and many more. Why own gold? First of all, the industry itself sucks. It's really in deep, deep trouble. No new discoveries are being made. The easy stuff has already been found. I've been in the mining business and the hydrocarbon business. You don't have, in gold mining, vast storehouses of reserves which could be tapped with new technology or with new techniques in fracking. We don't even have 3D seismic or its equivalent in the gold industry. So people aren't finding it. The major mining companies are producing faster than they can replace their reserves. In fact, they're producing at higher grades, which indicates that as a group, they're high grading. Eventually, the chickens come back to roost. The quality of gold mines has collapsed over the last decade. It's gone from an average grade of over 2 grams a ton to 1 gram a ton, which means that the cost of production rises. It's just simple math. If you have a ton of dirt here and a ton of dirt there, and one costs you half as much to get out, your cost doubles. So from the industry itself, you have a lot of factors which are indicating that we've reached peak gold. And the horse is already out of the barn. The average time it takes to be able to go from a discovery of gold to production is now over 20 years. It's not like hydrocarbons. When I got into that business and we made a discovery in Texas and we were just able to hook ourselves up to a pipeline and be in production, I thought, well, where has this been all my life? Well, there are 2 edges to that sword. And yes, we got very lucky, and we exited in 2007 when oil was at $120 a barrel. I would also point out that gold was at $650 an ounce. So in the last decade, gold has doubled while hydrocarbons, I don't have to tell you, have completely collapsed. One of the reasons is there are a lot of people who found that they could hook themselves up to pipelines. But meanwhile, big gold discoveries are few and far between. I'm not even adding the jurisdictional risk to it. So when you're in the business, you can look at this and you can say, the proper equilibrium level to be able to reward someone for going out and looking for this stuff and taking it up the value chain, assuming that you're in a jurisdiction that will one day, when you're producing, allow you to keep the fruits of that leverage. For that, the opportunity cost is so massive that I believe that the equilibrium level should probably be between $3,000 and $5,000. Does that mean that gold can't go from 1,300 to 900 before it then surpasses the 1,900 mark that it reached in 2011? No. But I would argue that seen through the prism of history, in the not too distant future, we'll view whether or not someone buying gold at 1,300, 1,200, 1,100, or 900 on its way to 2,900 or 3,900 will be somewhat akin to where the stock market was in the 1980s. Whether you bought the Dow at 12, 13, 14, or 15, did it really matter? That's what we look for. Now, the fact is that if we do get, once again, a hit to the global economy, I think that there are several things which are self-evident to me. First of all, populism, real populism, will prevail in the United States and in the West. Donald Trump is merely one expression of populism. Bernie Sanders and Elizabeth Warren are the other side. If we have another economic downturn ever again, if the laws of business are completely suspended, I don't know what's going to prevent the 75% of the American people who will go with a populist from doing it. Europe is really on the edge. And we just even saw it in the Austrian elections. And it's not just simply a function of immigration. You get another downturn, Corbyn will be elected prime minister. And Le Pen will be elected president of France. So you have, on the one hand, the West, which is on a knife's edge, dependent on the central banks to be able to maintain stability. And we already have the rise of quasi-alt-right governments in Russia, Poland, Hungary, etc. So from a political standpoint, not to mention, I can give you 10 or 20 different flashpoints for wars and all that other stuff, it makes some sense to own a little bit of gold. And if Ray Dalio is saying everyone should own some gold, and those that don't understand gold either don't understand history or the economics of gold, I don't feel the need to be in everyone's company, but between Dalio and Gundlach referring to gold as coiling like a snake, it's a nice company to be in, especially when these people are generalists, and if anything, Ray Dalio is the definition of hyper-rational. But the truth is you can own it for all the right reasons and yet protect yourself against the downside. You can give yourself protection against what the VIX is telling Boaz. You can give yourself protection against what the central banks are telling to Nouriel and to Jim. But ultimately, you don't need them. If the world does well, gold will do well. The Indians and the Chinese will take care of it. But if the world, for some reason, ever does poorly again, it may be one of the only asset classes that actually works. There was a professor of politics at London University who once said the definition of a true conservative is one who prefers present happiness to future utopia. I'm extremely happy.
So Boaz, maybe I don't want to put words in your mouth, but you seem to be relatively bearish as well. But you are finding opportunities now, even with the credit market roaring on the short side. And can you give us a little bit about where you actually are seeing opportunity even in this market?
Sure. I think I've never been an investor that's very directional. It's been much more about relative value, looking at a company and their various different securities and looking for mispricings where one market is giving you a different signal than the other. And so when people talk about, I'm really a credit investor by background, is high yield overvalued. The spread is almost in the lowest decile in history at 3%. Basically, you only get 3% extra for taking the risk of junk. Well, okay, these are times where there are a lot of things in their lowest decile ever, and there's nothing so terrible about credit spreads at 300 in a default rate, 3% in a default rate that's only 2% looking backwards. Yes, it might grow, it might prove that 300 was a foolish place to be long, but that's not where I see the greatest complacency in the credit market. Where we're really finding opportunities is where, even though the credit market is very healthy, looking at particular companies where it's not that my analyst has a really great read on what the future is going to be. That's very rarely the case. But instead, where I just look over at the equity market for these same companies and find an equity that looks nothing like the broader stock market that we've had. So you could find maybe 15 or 20 companies, some of them the energy sector, some in healthcare and hospitals, really actually a bunch in retail, where the credit market just doesn't care. You could take, until very recently, JCPenney, for example, their 3 or 4 year debt has been hovering right around par. And it was par a year earlier, and it's close to par today. But the stock in the last year has fallen from 11 to 4. And so 11 to 3 even. And so when we see a company whose equity is down 60 or 70%, and it's only rated single B or triple C to start with, and the credit market just doesn't care. I used to have, as a credit investor, the equity clients that I would talk to say, what we really are interested in doing in following the credit market is looking for signals, because that credit market is institutional, it sees things faster. We think equities are relatively dumb, and the credit market is just more sophisticated. And I think today that's no longer true. Retail investors own such a large swath of the credit market. I think, and in fact, in some ways, with all of the automation and so forth, I think it's actually flipped, and equity markets are more sophisticated. And so we find that credit has really traded, whether it's a good high yields company or a bad high yields company, in the same range. Whereas you can find some equities of these same companies that are telling you there is a problem with this company. And so just to sort of flesh this out in a different way, to say there have been very few defaults this year. And if you happen as a credit investor to have been stung by them, whether it's Banco Popular or in Singapore, Noble, the trading company Noble, which actually has $4 billion of debt, you would find a couple of others that actually the equity market was falling, it was telling you there was something wrong, and until literally the 12th hour, the credit market just didn't care. In the case of Noble, the stock is hurtling towards zero, and the bonds are actually going up. And finally, the bonds crash from 100 to 40, or in Banco Popular from 100 to 5. And so I feel like what's really dynamic for our strategy right now is that the markets are just not speaking to each other. Credit investors are not looking at the relationship with equity, or certainly not enough. The average credit investor just doesn't care because the last 5 years have been so great. And so we've been picking our shorts through that means. We happen to have, in Japan, found really good opportunities lately. So Kobe Steel, which is in the news, happens to be a position we're very involved in. And our fund has a broad mix of longs and shorts. And at the moment, we see far more interesting chances to buy busted equities and short their corresponding credit in the 90s to par.
What's your favorite right now?
Well, so in the hospital space, if you look at community health or Tenet Healthcare or community health, both are rated, their junior debt, their unsecured debt is rated mid triple C or high triple C, and you've had an 80% drop in the equity. And the equity to us, if you look at CYH, for example, really looks like an option. You have a stock that was $50 a share that's now at sub $6 a share with $14 billion of debt. And so community health with $14 billion of debt and barely $700 million of equity, if you did a screen, you would find very few companies that have 20 times as much debt as they have equity. And one of the reasons that matters is not just because the company happens to be very levered, because the equity is onto the problems, the declining EBITDA of the company, but sometimes a company can fix things. They can actually change their capital structure. A company in trouble, if they have enough resources, can issue equity to delever. But when you have so little equity left, and you have a very volatile stock, and you have the debt still trading in the 90s, community health stands out to us. And there are a dozen others where the debt equity looks mispriced. Dynegy, Rowan, there are a lot of examples where the equities have done quite poorly, and you don't really lose too much being short these credits.
Tom, I think I know your favorite stock pick, but why don't you tell us?
Well, the one on which I have metaphysical certitude is the one which I chair, and I'm not going to recommend it simply because I chair it. I chair it because I think it is a unique story in the gold space. It gives all that upside leverage to gold that we look for. It's located in safe places. That company is Nova Gold, which is listed in the United States as well as Canada. As you referenced in your introduction, it owns an asset in Alaska, 50-50 with Barrick, the world's largest producer, that will be, in one or two phases, the largest single pure gold producing mine in the world and in the safest jurisdiction in the world. It's also at a grade which is double that of mines coming into production. And it's, in our opinion, early days as to how big it is. It already has 40 million, 45 million ounces identified, and we think it can multiply. This is something that when gold begins the next up leg, when the coils start to unfurl, we believe that it will go up 300, 400, 500% without much difficulty. That's not unusual in our space. When you find the kind of asset that you're looking for, you ride it very hard. I think that this is not only the best, but in terms of its size, its grade, its exploration potential, its production profile, cost of production, and jurisdictional safety, we actually think it's unique in the space. So Nova Gold is our top pick, but we're bullish on those very few assets that we actually see as being North American-oriented assets. I think with gold, you want to be in places where when you go to sleep at night, you wake up in the morning and find out that what you thought you owned the night before, you still do, where the rule of law isn't a novelty. And having made my bones...
U.S. is still in that moment?
U.S. is absolutely still in that category. In fact, basically U.S., Canada, Mexico, so long as it stays part of NAFTA, and arguably if that changes, God knows where the price of gold will be going. But these could very well be the really big bubble of the future. Those very, very, very scarce assets that give you exposure to great leverage in gold in jurisdictions that allow you to keep it.
Great. So we want to open up for questions now. Yes.
What is the way for a small hedge fund to get the kind of exposure you're talking about on the vol side?
Well, there are so many different types of, there's equity vol, there's vol in China, vol in the U.S., and so if the question is what's the easiest way to buy some cheap volatility for my portfolio, one of the challenges is that it all depends, what your outlook is and what you're trying to achieve. Because the most attractive volatility, if you just want to buy something long term because you believe volatility will revert to the mean, actually the U.S. is very expensive, out 2 or 3 years. But China and Japan and Korea, for example, are actually extremely low because of that phenomenon I mentioned about retail sellers. But right now, if you said, I don't know how I feel about the next couple of weeks, and I wanted to buy something, it's really the most generic volatility you can buy, volatility in the S&P. If you go and have access to a Bloomberg account and you look at S&P, you'll see that if you bought a call or a put, because again, it doesn't have to be speculating on downside. You could be speculating on the tax bill happening. Implied volatility, the volatility implied for the next couple of weeks, is actually the lowest anyone has ever seen in their career. It's 5. The measure of volatility is in the 5s. This year we've realized 7, and so maybe Richard will invite me back next year and I'll say actually now it's 4. But we have to be nearing a level. Volatility, interest rates can be negative. Okay, let's just for 1 second. Interest rates can be negative. Volatility cannot be negative because then actually someone would be paying you to own options. And if we can enter in a world where someone says if the market goes up, you win. If the market goes down, you win. And if nothing happens, here's this money I paid you. So volatility does have a floor. Every quarter, the S&P does change its constituents. There is earnings. Earnings season is about to really kick off next week. And so I believe buying front end is very attractive because a lot of times things are bolts from the blue when you think about really major events, and so it's just so inexpensive. At our firm, we rebalance. So if the market goes up and down and finishes in the same place at the end of the period, we didn't just lose everything because it finished in the same place. We rebalance sometimes daily or even more often. So very front end volatility is extremely low, and the back end in Asia has never ever been this low, and there are many different forms this can take. So I'll leave it at that.
Boaz, we're on the second presentation, we've already heard once in 5,000, once in 100 years. I mean, it just, and then you're saying basically the whole market is massively short volatility at really bad levels. So it's kind of, is it fair to say it's kind of like a rubber band like this? So like when this unwinds, is it going to be very like wicked, or do you see a Goldilocks way out of this?
So at least for the credit market,
I mean, unless volatility is going to go to 0.
Well, yeah. And it doesn't, you don't even lose that. It doesn't cost that much to own at these levels. You get so much convexity, so much, risk reward so if it goes a bit lower, it won't be the end of the world either. My own view of where the real problems will be, where I wish I would have owned gold or what have you, is which sounds like I can own in any environment, but it's really the credit market gave us a signal last year that I haven't seen it written in this way. Q1 last year, you all remember energy did very poorly, but what you may not remember is that energy credit did so disastrously. So I'll just take as an example Chesapeake. Chesapeake had 3-year debt that was at par when oil was triple digits, and the debt went all the way to 11 in Q1 of last year, and today it's par again. So we fell, almost 90%. The equity of Chesapeake fell almost 90%. You as a credit investor, having foregone upside, equity upside, it's just here, give me my interest and please give me my money back at the end. You had no extra protection for being a senior creditor at Chesapeake. The debt fell 1-for-1 with the equity, which almost, from a theoretical point of view, should be nearly impossible. And why that is, in my view, because of this phenomenon about retail investors. So much credit now is held in mutual funds, in ETFs that are effectively overnight liquidity, and when investors want their money back, as they always do when the market falls. It's so pro-cyclical in the way that when it's hard to sell, they want to sell. And so the unwinding of credit, an energy credit, finally a dip that was not a buying opportunity, I saw in my career the biggest overreaction. It was granted in one or two sectors, the biggest overreaction of credit to equity. Credit fell super hard. Now, my comments a little while ago was that credit now is very invulnerable. Equity is falling, and credit doesn't even remember the lesson of early 16. So my takeaway is that someday there'll be a dip that is bought like energy credit was, but it was a bad opportunity, and the market falls more, and some brave soul buys again, and then it falls again because there's actually something wrong. And when finally we're in a correction market, I think what Q1 16 tells us, because that's where we actually saw it in energy, in the energy market, is that the credit sell-off will be far greater than people imagine, and it will again come back full circle to what Jim Grant said. There's no bank capacity to basically take risk, either because of the Volcker rule or because of the exiting of the shrinkage of the bank balance sheets to buy bonds from Fidelity or from PIMCO at risk. And the sell-off will be far greater, and we haven't even talked about the knock-on effects with the volatility seller who has to cover. And so maybe, to finish, you asked again about 1 in 100 years. We've had multiple 1 in 100-year hurricanes, right? But the selling of hurricane insurance did not contribute to that. We know that we believe other things did contribute, but it wasn't because too much hurricane insurance was sold. But if too much volatility is sold, it actually can impact markets. It can blunt the moves. It can blunt small moves. You sell it, it pops back up. Comey, sell it again. Kim Jong-un, sell it again. But if it actually goes higher, it is actually going to be the root cause of the overreaction to the decline in markets. And I think, so we have a greater chance of being in a stable market, but the severity, if we can become unstable in markets, will be far greater than it ought to have been. And I think Q1 16 is a signal that this isn't just my prediction, that we actually saw it happen in energy credit.
And will they print money then, Tom?
Well, it's hard. The point is this. You have to suspend your belief or disbelief in the state of the world economy because of the massive debt which was accumulated in order to prevent us from going into the equivalent of the Great Depression. You have to ask yourself, if we have an economic downturn ever again, if one day Mario Draghi would say, we will do whatever it takes, and the markets continue to fall, watch out. I hope they don't, because I've got 3 kids, and I have zero doubt that the next economic downturn is going to be met with incredible social displacement. It's already happening. It's happening in plain sight. The key is, what tools will they have? How far below zero will they be taking interest rates? Will indeed Boaz say, it's hard to believe, but they are paying us to take these options? We don't know. And you referenced my love for the big cats. My partner in creating Panthera once said, you're very similar to a big cat. He said, they're not the sharpest tool in the shed, but what they do know is that when they don't understand something, they jump into the tall grass, and then they look to see what's actually going on. We are in so many 1 in 100-year events, so many unprecedented events. We are in such uncharted waters that it behooves someone to ask themselves the question, should I not find a way to protect myself, whether it's through the volatility in exchange-traded markets, whether it's through gold or something else, just in case. The problem is, just as retail investors will sell at the worst possible point, they also buy most often at the worst possible point when the risk-reward ratio is as poor as it gets. And then as prices go higher, they're telling their brokers, why didn't you tell me to buy more? And then when prices turn down, they're saying, well, why did you put that rubbish into my account in the first place? I think that we have to ask ourselves, where can you find a way to be able to make money if the world is doing well, but also not to get carried out on a stretcher if any of the black swans that are darkening our skies should choose a light or to alight in any other place. So I don't know whether they're going to print money or not, but if they do, if they go back to what Bernanke did and they try to revive that and it doesn't work, it's game over for a long period of time until the plumbing flushes itself out, which will be so painful. And again, most importantly, it will be a disaster from a socio-political standpoint. We're already seeing the canaries in the coal mine. I hope, and hope has to be part of any strategy, but it's not a strategy in itself. I hope we manage to get through this.
Anybody have any questions? Tom, I have one question, is just on a different note, as somebody who was advised by their wife and children not to wear my Snoopy watch today. What's the, are those cats on your tie?
Snow leopards.
Snow leopard, is that?
Snow leopards. Well, amidst the risk-reward scenarios that all of your speakers have spoken about, I can actually give you one piece of news. On Saturday, an announcement was made in Monte Carlo in which, for the first time ever, a major Chinese philanthropist, a multi-billionaire woman entrepreneur by the name of Madame He Jianyu, made a $20 million commitment to cat conservation globally as the first of a $1 billion pledge to engage in species conservation. Now, if you consider the enormity of the pledge combined with the source, because China is not usually considered to be part of the solution, but in some instances part of the problem, I believe this has the potential to be a watershed moment in wildlife conservation, which in a world of so many different variables is actually a nice piece of news to rejoice in.
So to recap, so we have long volatility, long gold, short JCPenney, and long snow leopards. Is that fair?
You've got it.
Okay, great. Thank you, guys. We really appreciate it. That was great.
Thanks.